Joe, if this wasn't the kind of day where you like jump out of bed ready to get up here and talk about this incredible market day that we have, I don't know what's going to get you to do that. I mean, you got the Fed decision, you got the $5 trillion Nvidia, you got some incredible earnings coming up, and the market's hitting record highs again into all of it.
Sure is a remarkable day, and I will say this. I think I speak for the majority of portfolio managers out there. It's somewhat perplexing. It's perplexing because the performance that we're seeing is being driven once again by this narrow, concentrated set of equity names.
Why is that so perplexing to you?
Well, it's perplexing because if you look at the S&P equal weight, it's down once again today. Yesterday, we had the widest differential between the S&P 500 and the S&P equal weight going back into the 90s. So most portfolio managers can't say, okay, as Steve has rightly suggested, I'm basically just going to put my chips on these 7 technology names, and they're going to work for me. And they are working. There's justification there. But it's challenging for the rest of the portfolio manager environment. I will say this. What I believe that ultimately does is I think it's going to accentuate this chase for performance through the month of November, because it's going to put people in a position where you look at the last 2 days. Myself, look at Joe T. The last 2 days, Joe T is down in a market that the S&P is higher. You look at it and you feel as though that
would leave somebody perplexed.
Well, it's not just me. It's just not me.
Yeah, you're perplexed, right?
I was perplexed. Look, I think Joe's right. This is sort of lunacy. You know what we're seeing going on. I mean, we'll talk about it later, but you got industrial stock up 13% today. I mean, that's an AI move right there. But here's what I think is actually happening. Companies that come out, you're getting breath, even though undeniably, Joe, you're right. The worst breath, relatively speaking, since 1990. But I think you're starting to see, if you commit to AI as a company and you show some increased productivity from it, and your adoption, as we saw with Target, as we're seeing with UPS, as we'll see with others, that you're going to get a halo effect from AI, so you see it broaden out. Now, you won't see it broaden out to the whole market, but selective ones, like what we're going to talk about later, it will happen. So that's very positive right now. The question is, when does it turn negative? Because you're displacing some real big buyers of consumer goods, meaning white collar, as we saw with Amazon, 14,000 of them. So when does the trade-off happen? Now, I don't think we're near that point yet, but it's going to be a big question the market's going to have to answer. Will productivity of those companies and increased earnings offset massive, and I do believe massive unemployment?
So Joe, I think, was alluding to this stat, Kerry, that Bespoke put out about yesterday's trade, that yesterday was the S&P's worst breath day ever for an up day in the market. Since 1990, the S&P has never had weaker breath on a day that it closed positive. It closed up 0.23% with a net advanced decline line of minus 294. 104 stocks up, 398 down. Now, you can hold that up and say this points to a weaker market under the surface or whatever you want to do, but this market hasn't been as strong under the surface of AI for a while now. So are we really to make something of it today?
Well, today's probably worse than yesterday. I think that people who had underperformance yesterday probably have worse performance today.
I don't mean it even so specifically as today, yesterday, but now.
In general,
like now we're going to make a big deal about this as we're about to get the 3 mega caps reporting and Nvidia hitting $5 trillion in market cap?
Well, it's more of what we talked about the last time I was on, where we discussed how this is an environment for which the largest companies have everything they want, meaning they can figure out a way to make their problems go away. If it's an antitrust problem, any type of competition, if they've got some legal challenge, they make it go away. They agree to give some of the proceeds to the government. They're able to maneuver in this environment, particularly with this administration. So what happens that might be good for the largest names is not necessarily good for the rest of the market. And the market keeps rewarding Google and Meta and Amazon and Apple Apple, Microsoft, et cetera.
Wrongly so? Do you think wrongly so?
Correctly
because
so.
you're an Alphabet, Microsoft, and Meta.
Yeah, so correctly
and
so.
Nvidia.
However, the problem, however, is that they get to be such large weights in a portfolio that you're not taking into account the risk of concentration. And that has become the biggest challenge to portfolio managers, fund managers everywhere in this country. They cannot diversify their portfolios without losing ground to the S&P.
Without losing performance.
Correct.
Okay, I got you.
Of
course.
So Alphabet hits a new record high today into the print tonight. Microsoft, $4 trillion in market cap yesterday into the print. Meta is in danger of snapping 8-day winning streak into its own print. But there's a look at Alphabet shares. You want to, Liz, take issue, agree with, or whatever with any of the comments that were already made on the desk?
I mean, I'll take a little issue with the perplexing comment because we've been
good.
Talking,
I did too, so I'm glad you did. Thanks for the backup. Go ahead.
And on his birthday too, right?
Joey,
yes.
On his birthday.
Happy birthday!
Happy birthday, Joe.
Thank you very much, Liz. Continue, please.
So we've been talking about this for a long time, that there would be a chase into year end, and here we are. 1 month into Q4, and the chase is on. The large cap love affair is on. The risk on speculation trade is alive and well. The game is strong, right? And this is happening during a week when Q4 seasonality usually picks up, and then we have this run into year end, so that supports this even further. And then this is also characteristic of late cycle large cap behavior. Usually when you have, number one, late economic cycle, late cycle in a rally, you also have concentration that just gets more and more concentrated until it turns the other way. There's no timing that could go on for a long time, but all of this is emblematic of that same trend.
Really? I mean, I've been hearing this a lot over the last year or so, if not longer. Are we really that late cycle? How could we be late cycle if people say we're in like the second inning of the whole AI spend and the AI boom? That doesn't match up in my mind.
Somebody's wrong. We don't know who yet. So late cycle in the sense of the market cycle. There's a business cycle and there's a market cycle. Right now, we are a little bit convoluted on where we are in the economy. Number one, we don't have a lot of data, but we're coming down in inflation, which is not usually late cycle behavior. If we get into 2026, it's possible that we have stimulus that comes into effect that actually drives inflation back up a little bit. We never actually hit target. We start rising again in inflation. Unemployment starts to rise. That starts to feel more late cycle in the economic standpoint.
But I mean, we're cutting rates. However, the market's late cycle. Yep. We're cutting rates.
Well, if we have to pause that, right, there's all of these question marks that could happen in 2026. That's not a 2025 story.
But there's it seems a lot of if. If this happens, if that happens. But what's the likelihood? We play probabilities, too, more so than ifs, right? Right. Isn't that what you all do?
Yes. Can I just make one comment on cycle?
Without full information.
2000, March of 2000 was when the market crashed, right? And the S&P was down 50%, the NASDAQ was down 90% at the worst. And it was the beginning of the internet, right? It was the beginning of the internet. But it was also the end of this enormous rise, the euphoria about internet stocks that did come down crashing. So they don't have to coincide, and the cycle on the market.
Right. They're not supposed to coincide. But right now, I think we are at a point where actually the market is very detached from what the economy is doing. That doesn't make the market wrong. The market is always using the information it has and the optimism that we're looking at with AI.
Do you think the market's detached from what the economy's doing? The economy's pretty good.
Pretty good, but it's not heating up. It's cooling down. So if the market is with the economy, the market should be front-running maybe a heating up in economic activity, but we know that a lot of the metrics are showing us that economic activity is actually cooling down, which we needed to happen in order to bring inflation down. And now we're getting announcements that are getting slightly concerning, layoff announcements from a lot of bellwether companies, but we don't have any labor data. So right now we can still say that the economy is okay and the labor market is okay because we don't have any data that proves otherwise. But when it starts coming back out again, we don't know what that'll look like yet.